Welcome to this update to the S&P 500, and I'll also be going into the macro situation. Please remember I do these videos for fun and make sure you speak to a qualified financial advisor. So I like to start with the big picture here, and we have the S&P 500 going back to the 80s. Back then we used to have these boom and bust cycles with the dot-com bubble and the credit crisis being the final one. And during this time, governments used classic Keynesian economic doctrine try and control the economy using interest rates only. In the credit crisis, we saw an increase in the gradient here of the stock market always going up. And this is what's known as the new Keynesian economics period. But really, the main additional thing was the use of quantitative easing or money printing. Perhaps they could only get away with this, though, because this time period was marked with a sharp increase in deflationary forces such as globalization and the acceleration of advantages from the internet and new technologies. Following the government behavior after the Wuhan outbreak, we've had what some people have called experimentation with MMT, but which I'm calling here New Keynesian Economics Plus. And here we had the introduction of even more stimulus, including lots of fiscal stimulus government programs. And we had the kind of QE or FANG bubble. And now, in the run up to the Trump election, we had the AI bubble. And we really did see this breakneck upside in the S&P 500. Following the Trump election, however, he announced the tariffs, and we had this nano crash and V-shaped recovery, very similar actually to what happened in 2020. And now we're around all-time highs, but in a kind of very uncertain time point. And the reason for this crash was, of course, the realization that the Trump government was going to pursue economic nationalism. So he's already stopped all of the cheap labor from coming into the country. But the other main plank of economic nationalism is the onshoring of high-tech manufacturing, and the tariffs are a big part of that. So now we're in a very uncertain time because the tariffs, although they've only come about in piecemeal, presumably should lead to inflation, as well, of course, cutting off all the illegal immigrants. And so this makes for a very uncertain time at the moment as we move away from New Keynesian Economics Plus and into a period of economic nationalism. In terms of the main macro KPI, GDP growth is at about 2% according to GDP Now. So that's actually on track. But I have that as yellow because according to blue chip consensus, it might be a bit lower than that. Unemployment's great at 4%. Inflation is a bit high. Now, for my headline number here, I've used the current quarterly number and then added the previous two numbers. But it is high, and actually, as I'll go into later, it's high either using long-term or short-term monthly metrics as well. So yeah, inflation's a bit high at 3%. So this is a worry. Stock markets are doing great, and house prices are currently kind of stable. We're kind of in an okay situation in terms of the key macro KPI there. When we look at the long-term trends, we see that the interest rates are kind of higher than they were, but they're not too bad against kind of historical norms. Inflation's much better than it was following the government shutdowns. With the tariffs probably only kicking in soon, they're kind of not really a healthy number either. And GDP is kind of looking a bit modest at the moment. In terms of unemployment versus a long-term trend, it's looking great, but it is trending up. And in terms of government debt and fiscal deficit, it's not good, and I'll come into that later, but it kind of looks reasonably sustainable for the short term here. This slide outlines what I meant when I talked about New Keynesian economics. And the important point is it's only because of the globalization that the US with the US dollar as the world reserve currency, was able to get away with quantitative easing and kind of artificially low interest rates. Now, with the globalization part being taken away with tariffs or reduced by tariffs, there is a worry that that's going to lead to inflation. And you see, I've got here as a tariffs putting a kind of couple of blasts on the rocket here for inflation, as has closing the borders to illegal immigration. Now, of course, in the future, AI and robotics will actually be a extremely deflationary force. But the worry is what's going to happen in the transitionary period. In terms of the US dollar, then, which is obviously a very important thing to be watching as we go into this uncertain moment of history. Actually, the US dollar is at a reasonable number at the moment in terms of the Dixie index. Ever since the announcement of economic nationalism, it's been in a rapid decline. In fact, it's dropped 10% since Trump got in, which is very quite significant. But then in terms of kind of long-term trends, I still think we've got quite a bit of altitude left before we have to go into panic mode. And in terms of the yield curve, it's actually not looking bad at all. Maybe we get a couple of rate cuts. On the short end, it has been dropping. And at the long end, it's actually looking quite stable. So really, the yield curve to me is looking fine as far as the US is concerned. My theory for over a year now has been that we're going to see a normalization of the yield curve. And for me, really, it's just a question of will it be down to say 3.5% and a bit higher in the long end, or will they stop at say 4% and then we go long on the long end? But however the normalization happens, to me, it's happening in kind of a good way. And when we look at 10-year Treasury yields, there's a very interesting pattern here. I don't know if it's just trending down here in a channel, or if this technical pattern breaks, we could see it shooting up. When we look at the historical data, see that if it was to shoot up, that wouldn't in any way be unknown territory for 10-year yields. But to the same token, it's kind of looking stable at the moment. I can't see a return to low yields really. So the era of cheap money seems behind us, but the situation's kind of looking fairly stable at the moment, but with some interesting patterns emerging. And comparing quickly with the UK, there's a similar pattern. So here I've got 10-year bond yields against the Fed funds rate and inflation. And again, against the historical context, these are kind of low, kind of mild numbers we're at the moment. So sorry to go back to my pet theory, but I really could see a normalization of the yield curve with higher rates at the long end and relatively high base rates. That looks quite plausible when you look at this data combination here in the long term. Here I've got my month-on-month updates. So of course we know interest rates have stayed the same despite all the drama. I don't really expect them to drop by much unless something dramatic comes into play. Quantitative easing continues to drop, but when we look at the long-term data, we see that although it is nice that they have actually reduced it by quite a bit since the peak of the madness, the rate at which they've been doing quantitative tightening has definitely reduced quite a lot the last few months. So it's almost as if because there's starting to be signs of weakness in the economy, maybe they've had to kind of take their feet off the brakes a little bit here. Inflation is on a year by year basis high at 2.7%. Now that's the kind of headline number the Fed always points to. but I prefer using month-on-month CPI data as much more kind of accurate and regular and relevant to now data. Well, on the month-to-month data, inflation's high. That would be over 3% if you extrapolated it out to a year. For me, the best data is actually quarterly data points. We've got the best trade-off there between immediacy of the data and accuracy of the data. And so with my quarterly data points, though, we're still high here. That's still 3.6% if you passed out from a quarterly number. So regardless of if you look at this medium term, long term, or short term data, inflation's high. House prices are doing well, or they're doing okay. They're dinking down a little bit, but there's kind of no alarm. And in terms of real GDP, we had obviously a good quarter, the first quarter of this year, but according to the Atlanta Fed GDP Now estimate, it's now down to 2%, but that's actually a perfect number. But the blue chip consensus has us down at between 0 and 2%. So really, I think the GDP numbers we have for this quarter are actually good, but maybe dimming down a little bit from the first quarter. In terms of unemployment, it's a good number at 4.2%, and I've already showed you the long-term data for that. In terms of government debt as a percentage of GDP, it's actually improved from the first quarter. It's not good, but it's probably sustainable in the short term. There's a lot more detail on this at the end of this video. So overall, things are actually kind of okay at the moment in terms of the macro picture. But the main points are we do still have mild inflation. And it looks like GDP is kind of dipping a bit. So when we look back at the charts, in light of the macro data, we're definitely in a very uncertain period at the moment. We've got to see the effects of the tariffs. How much does that drop GDP growth? How much does that cause inflation? There's a lot in play. That's why my attitude is to just stay away from the US at the moment, because there's kind of easier money elsewhere. Economic nationalism is a 10-year project to really get established in the US. And I think there'll be a real tug and war along the way. For me, like the upside would be just a continuation of this 16% yield from now. But as the tug and war develops, we could see like drops due to inflation, etc. And there are different asset classes where you can invest your money at the moment. So for those who like it kept nice and short, that completes my video. And for those who want to leave me now, I suggest you take a look at this video on my channel, Gold and its Epic Cup and Handle. However, for those of you who like a bit more detail, I'll now go into depth with a bit more macro that I'm tracking. I started inputting the data of this slide back in 2020, and I don't really use it much anymore, but I've just kept updating it. But it is noticeable how ever since we entered NKE plus, look at the trajectory of GDP growth. But if like what we had back here is kind of what governments tend to want and what the World Economic Forum tends the governments to want to have, you've got to ask yourself, do you expect it to keep going up like that? Or with this economic nationalism, are we going to have a return to something more normal? And then looking at the S&P 500, its rise looks a little bit audacious versus the increase in the GDP. So that's just something I couldn't help but notice and mention. Just eyeballing this chart, what do you think is going to be next for GDP, and what do you think is going to be next for the S&P 500? In terms of the US fiscal deficit, and please remember that that's a major factor in terms of the yield curve. Well, the US fiscal deficit, as you can see, does look kind of on a uncontrolled path here if this trend was to continue. We can see that the government's spending about the same as it was in the last few years, despite Elon Musk's efforts. And so, like, this is the kind of new normal. And this chart shows on a monthly basis whether the government's in deficit or surplus. So I've got 2019 as a good reference year, and when we look at the government outlays to this fiscal year so far, it's kind of a similar pattern. But you notice how the amount being spent on interest on the debt has jumped up from 8% in 2019 to 14% now. Here we've got the government receipts against the government outlays, and you see this nasty 33% deficit here. And this net interest component, the government is kind of at 14% of all outlays. It is a kind of a bit of an obscene number. And the point is, yes, the government can pay it off fairly easy now, but you see how it gradually increases, and then when you then look at a period of time here of 5 years, it starts looking, you realize that like boiling a frog, it kind of gets worse and worse. The government debt is kind of sustainable when you look at it in a long-term picture, but sooner or later this interest component will need to be addressed. But one thing is Trump tariffs. So I've got here the monthly receipts, and when you look at the previous June with the current June, you see that this other category here, that includes custom duties, so that includes the Trump tariff. So it's interesting that we do see an increase. And actually, when you look at the raw data, this, by the way, is the US monthly Treasury statement. But when you look at the raw data, we see that whereas last year, we see that in the month of June, you see that the amount of customs duties that the government took in June was actually half for the entire first 9 months of the previous fiscal year, and we're currently at double what we were at this point of the previous fiscal year. So bearing in mind that a lot of the tariffs haven't even properly kicked in yet, there is a sign here that maybe these tariffs, although they will create some inflation and probably dampen the economy a bit, they could actually help reduce the deficit in a way that could have Trump looking like a hero if the US government managed to balance the books even. Here I've got historical inflation, and just look at how kind of mild the current numbers actually are compared with these historical norms. Here I have long-term GDP, and I find it quite scary seeing like this exponential growth here. Here we have unemployment against historical norms. And my final slide, as always, is the M2 money supply. Again, we have this frightening exponential curve. Now, if you get that data and move it to only a 1 year time frame, it looks a lot less frightening. And again, we're kind of boiling the frog again. Actually, in the near term of every given year, it's currently kind of mathematically not too mind-bending, the amount by which the M2 money supply is increasing. And obviously, it's great for everyone who owns stocks. But of course, maybe in 10 or 20 years, the actual slope of that curve will start getting rather dangerous. It looks like when you measure how many bacteria are growing on a Petri dish, and you have to worry about what happens when we get to the death phase. So that completes my video for looking into the S&P 500 and all sorts of macro stuff. I hope you found this video useful, and speak to you at the next one. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.